let's get started then with our first conversation. And like I mentioned, we're going to be speaking about your credit score. It's something that isn't talked about much, in my opinion. And I think that we should rectify that. If you think about it, you don't need it till you need it. Take, for example, the possibility that you aren't looking for a home just yet, but then a couple of months down the line, you stumble on a great deal and you decide to go for it. You don't have the necessary funds, so you have to take a loan. And that's where the credit score becomes so important, because that's one of the first parameters that the bank will look at when it considers if they want to give you a loan and what the rate of interest should be. So how is it computed, and can you improve your score? My first guest is Aparna Ramachandra, who is the founder and director at rectifycredit.com, and she's got those answers among some others. Thank you so much, Aparna, for taking the time. Let's start with the most basic question. The credit score, how is it computed, and how does your score get impacted if you don't have any debt or if you've never taken a loan?
Good evening, Alex. To answer your first question, how is the credit score computed? This is literally like a Coke formula. So every bureau has its own algorithm based on which they calculate the score. But they are broadly based on 4 or 5 parameters, like how good are you with your repayment, what kind of loans have you taken, whether you've been paying on time, what's your portfolio, your debt portfolio like. So these are broadly the parameters, but of course there is much more to it than just these basics. And if coming to your next question, how does your score get impacted if you've never taken a loan? Now, if you've never taken a loan, all the bureaus call you something like what is known as thin file or no score, which means they have no history to give you a score. So a credit score is basically a history of you, how you have behaved with your loans and credit cards, your debt. So if you've never taken anything, they have no history to calculate that score for you. So they cannot give you a score. So they are called either thin file, or they are called new to credit, or they are called, or what is known as no score. So typically, in such a scenario, banks do not give you an unsecured loan in the beginning. So you will not get a credit card or a personal loan. What you might get, if you are lucky and you have a long-standing relationship with your banker, maybe a mortgage loan. So, like the example that you are giving, a home loan may be possible to be approved, but for sure you will not get an unsecured loan if you do not, if you are new to credit, you've never taken debt earlier.
Okay. The reason I ask, Aparna, is because I know of a case personally of somebody
Yes.
who's used a credit card long back and didn't really use it extensively, had a credit score, CIBIL score of over 800, and cancelled that credit card, and then maybe a couple of years down the line, or 1 or 2 years down the line, found that that credit score had fallen to below 800. The reason I was asking about how your credit score gets impacted without a loan was just this. Is there
I get
something that could have happened in that interim?
That's a very classic, very good example that you've quoted for me to explain. Now, this credit score, if you see a credit report, it is typically reporting the last 36 months of data. So, in the example that you gave, if if the person that you knew, if he's taken a credit card earlier, never defaulted, paid on time, everything was well, and he just happened to close that credit card. And in the last 3 years, he has neither taken any loans, there is no ongoing loan, or there is no live credit card. So, which means again, the bureau has no data to give about him. So, it is not something that is negative. Like he's not like a defaulter, but then it is only the helplessness of the bureau because there is no data to be reported against him, which is why the score goes low. Usually, the score doesn't go low, it says no history. So when last 36 months, if there is no data, if there is no loan, no card going on, you're in the place of your score, the bureau report will always say NH, which means there is no history. So that's the scenario. So the scores don't fall, they just don't have a score to give you. So it is always good to have at least one credit card going. if not anything else. So the least that you could do is just, do your basic grocery shopping, or just fill your petrol, or do something basic, but keep one card live and be good with that card, so that tomorrow, like when you said you're looking for a home loan, you have a history to prove, and there is already a credit profile that is available for the bank, and rest of the documents, if they are in order, then they are in a position to give you that loan.
I'm very glad that you pointed that out, because that was going to be one of my questions. How do you, it's essentially making a record of your payments, of the fact that you are credit worthy, so that banks have, or rather the credit bureau in this case, has something to go by. Now, assume that you've been a bit tardy, okay, but you've made your payments. In the example that you've given, Aparna, where you talked about a credit card, you missed one payment. That is definitely going to have a bearing on your credit card, or on your score, on your credit score. How quickly can you rectify that, and how do you go about improving your credit score?
See, one dip, I mean, I'm sticking my neck out to say this, but one dip really doesn't impact you very adversely. But if you've been consistently bad, is where it is going to adversely impact. Now, for example, during this recent pandemic, there were quite a few of us who were not in a position to repay the whole amount, or 1 or 2 months we couldn't pay. All things happened. The system, end of the day, is dealing with human beings, right? So there are few lows, there are ups, there are normals. So what can happen, or what happens rather, is if you after that sort your act together, and then you continue to pay on time, and you are good with your cards and loans, then there is no hassle. But like I said, if that sliding is just going to go downhill, is where it is going to impact you adversely. So one off, if you've missed a payment, or say for example your due date was 15th, and one particular month you ended up paying on the 25th or the 31st, but you paid the whole amount, they are not going to hold it against you. And it's not going to impact your profile as adversely as you consistently for 3 months either paying less than the amount, or not paying at all, or checks continuously getting bounced for your loans. Those are the things that hit you badly. A one off, a one dip is generally not going to hit you as bad.
What about your utilities? And here I'm talking about your gas bill, your electricity bill, your phone bill. Do these also play a part, or is that just urban legend?
That's the urban legend. Currently, these are people that are still not submitting their data to the bureau. So currently, it is only your all kinds of loans and cards, uh, and the lenders that are submitting the data to the bureau. So the utilities, like you mentioned, phone and gas and electricity, is still not there. So that I mean, you missing those payments is not going to impact your credit profile.
Okay. Can you break it down for us, Aparna, in terms of what you consider, or what is considered a very, very good score? I know for a fact that banks offer you the best rate of interest if you have a score above 800. But how does it work below that?
Alex, there are two things that I would like to use this channel to, educate and reach out to the larger people. When a lender is checking your credit profile before he decides about your credit worthiness and whether your loan application should be approved or not, the score is not the only thing that he's checking. They are looking at your entire credit profile. So a credit profile has multiple things. There are instances where people have 830 score, but their home loans still get rejected despite they having a 6-digit income or a 5-digit income, or those kinds. So it is not the credit score alone that a lender is looking at. However, what happens is, when you're looking at unsecured products, when you're looking at personal loans, when you're looking at credit cards, when you're looking at working capital loan, though overdraft. So those are scenarios where lenders are very finicky about your credit scores, because generally, I mean, it is logical. Higher the score, better is your credit profile, better is your credit worthiness, and hence they are okay to give you the loan. So in a standard scenario, if everything else is normal and all is good, anything which is above 750 to 800 is a good score, where even if you apply for unsecured products, your application is going to go through. But if anything which is lower than that is a question mark. Now, having said that, if you're looking at, say, for example, a home loan, and you are somewhere at 690, or you're somewhere below that 700 mark, and the lender sees that there are small little discrepancies or issues, and which is where the thing is, they may take a stand, they what is called in the banking parlance as deviation, and still approve your loan. But what they do in a scenario like that is they charge you a higher rate of interest. So this is scenario number one. Scenario number two is there are NBFCs or tier 2, tier 3 lenders who are happy to lend even for 690, but they would ask you for a higher collateral, a higher rate of interest, other processing fees, so all of that. So to answer your question, if lower is your credit score, higher is the interest that you will pay, and vice versa.
Okay. My last question, and this I'm trying to understand if you've had conversations with anybody who's taken a moratorium last year. Did their credit score get impacted by that? Because I'm not really certain how the credit bureaus ensured that that happened, or that was accounted for.
If you remember, RBI was very clear, and it gave enough. I mean, even the finance minister who was giving those, statements, they said that it should not be adversely reported, which means a lender could not have or should not have reported to the bureau that this particular borrower had applied for a moratorium, and it should not be held against them. So if you see the credit report, you will not figure out whether this person had taken the moratorium and that has adversely affected that particular borrower. But what has happened in almost 60% of the cases is, but logical, the people who opted for moratorium, there was 15% or 20% which, as a knee-jerk reaction, opted for the moratorium even if all was well. Say, for example, a salaried class where his salary was not getting deducted, but he somehow panicked and he opted for the moratorium. But otherwise, there was a chunk which was definitely in a soup, and that's where they took benefit of that moratorium. So after the moratorium ended, they have continued to be in a situation where they have defaulted, where they have not paid their EMIs on time, and together now for 5 to 6 months those EMIs have accumulated, and obviously rate of interest, penal interest, compounded charges, everything is now like ballooning. So we are seeing a lot of those cases now, where we are talking to the lender to see how this can be reworked again, whether a new EMI can be worked through, and lenders are not very comfortable. So that is where the scenario is. So during the moratorium, no lender reported this as an adverse thing that a particular borrower had taken the moratorium. But in reality, post-moratorium, we are seeing quite a few where the EMIs have been little high ticket size, is where the defaults are happening.
Okay. I think we've had a pretty comprehensive conversation, and I'm pretty sure that a lot of people tuning in, Aparna, have gained some knowledge from this conversation. Thank you so much for taking the time.
Thank you, Alex.